Welcome to Financial News Daily, your trusted source for the latest global financial updates. Today is May 29th, 2026, and today we are answering the question I get asked most often. If you had 20,000 US dollars right now in this exact market, where would you put it? Gold? Stocks? Real estate? Bonds? Before I give you my personal breakdown, let me walk you through the key events shaping every financial market on the planet right now. Because to invest wisely, you must first understand what is actually happening in the world. Let's get into it. Event number 1, the US-Iran War and the Strait of Hormuz. This is the single most important event driving global financial markets in 2026. The conflict, which erupted in February 2026, has triggered a near-total closure of the Strait of Hormuz, the world's most critical oil shipping route, through which 20% of all global oil supply passes. As of today, May 29th, fresh U.S. strikes on an Iranian military site have clouded the outlook for peace negotiations. Key disagreements remain unresolved. Tehran insists on maintaining control of the Strait of Hormuz and preserving its nuclear program. President Trump has firmly stated the U.S. will not accept what he calls a bad deal and has rejected easing sanctions on Iran. What does this mean for your money? Rising oil prices fuel inflation. Inflation delays interest rate cuts. Rate cuts delayed means bonds stay weak, and uncertainty keeps gold elevated. Every investor on Earth is watching this situation every single day. Event number 2, gold's dramatic correction. Gold hit an all-time high of $595 per ounce on January 28, 2026, the highest price in recorded history. Today, May 29, 2026, gold is trading at $4,520 per ounce, a correction of nearly 19% from that peak. Why the drop? Growing optimism around a possible U.S.-Iran peace deal has reduced safe haven demand. But here is the critical context. Even at today's price of $4,520, gold is still up 41% compared to just 1 year ago. And the World Gold Council has confirmed that global gold demand hit a record high in the first quarter of 2026, with bar and coin demand surging 42% year-on-year to 474 tons. Central banks from China, India, and Poland continue buying gold aggressively, reducing dependence on the U.S. dollar. Morgan maintains a year-end target of $6,000 to $6,300 per ounce. BNP Paribas projects $6,250. The correction we are seeing now may be exactly the buying opportunity long-term investors have been waiting for. Event number 3, the Federal Reserve and inflation. The U.S. Federal Reserve, now led by new chair Kevin Warsh, who assumed office on May 16, 2026, is holding interest rates steady at 3.5 to 3.75%. Here is the alarming detail. U.S. inflation hit 3.8% in April 2026, the highest level since mid-2023. The Iran war has pushed energy costs higher, which ripples through transportation, food prices, and utility bills worldwide. 4 Fed policymakers dissented at the last meeting, highlighting a growing internal divide. The market now places a 67% probability on 0 rate cuts in 2026. Fed official Lisa Cook has backed steady rates for now, but left the door open for hikes if inflation accelerates further. Fellow Fed official John Williams warned that inflation could rise toward 4% headline and 3% core in the near term. What does this mean for investors? High rates for longer means bonds remain unattractive, real estate stays under pressure, and cash sitting in savings accounts is slowly being eaten by inflation. Event number 4, stock markets. Despite everything happening in the world, the S&P 500 continues to trade near record highs in 2026. 78% of S&P 500 companies are beating earnings estimates, above the 10-year average of 74%. The AI investment wave is driving extraordinary performance in semiconductors, technology, defense, and energy sectors. However, this is not a rising tide that lifts all boats. Consumer discretionary, traditional retail, and office real estate are struggling significantly. The S&P 500 is up approximately 250% over the past 10 years, averaging 9% per year. But experts at Seeking Alpha warn the traditional 60-40 portfolio, 60% stocks, 40% bonds, is now considered a bad strategy for 2026 due to bond underperformance and equity concentration risk. the smart money is moving toward a more dynamic allocation approach with reduced bond exposure and increased alternatives, including precious metals. Event number 5, global real estate. With interest rates remaining elevated worldwide, the global real estate market continues to face headwinds. High mortgage rates are making homeownership increasingly unaffordable for buyers in the U.S., Europe, and Asia. Commercial real estate faces deeper challenges. Office vacancy rates remain at record highs as hybrid work becomes the permanent norm. However, for investors with patience, industrial real estate, data centers, and logistics hubs near AI campuses are delivering exceptional returns. And in emerging markets, Vietnam, India, and Indonesia, urbanization continues to create strong long-term demand for property. The key message on real estate in 2026: direct property investment is difficult in a high-rate environment, but real estate investment trusts, or REITs focused on data centers and industrial assets, remain an attractive alternative. Now, the moment you've been waiting for. If I had $20,000 today, May 29th, 2026, here is how I would personally allocate it, based on everything we just discussed. Let me be completely transparent about my reasoning. Allocation number 1, gold 35%. That is $7,000. Here is why. Gold has corrected 19% from its all-time high. Central banks are still buying. The Iran war is unresolved. Inflation is at 3.8%. JP Morgan targets 6,300 by year-end. This is not speculation. This is a documented global trend supported by institutional data. Gold at 4,520 today, potentially targeting 6 to 6,300. That is a possible 33 to 39% upside from current levels. I would split this $7,000 between physical gold ETFs and gold mining company stocks, which tend to outperform gold itself during bull cycles. Allocation number 2 is 40%, that is $8,000, but not in broad index funds blindly. I would focus specifically on AI and semiconductor companies, the dominant growth engine of 2026, defense contractors, which benefit directly from the current geopolitical environment, energy producers, which profit from elevated oil prices. The S&P 500 as a whole has returned 9% per year over 40 years. The right sector selection today could significantly outperform that average. I would use ETFs for diversification, not individual stocks, to manage concentration risk. Allocation number 3, bonds. 15%, that is $3,000. I know what you are thinking. Didn't we just say bonds are the worst performer of the decade? Yes, but here is the strategic thinking. With rates at 3.5 to 3.75% near cycle highs, if a peace deal happens in the Middle East, if oil prices fall, if inflation drops, the Fed will cut rates. When rates fall, bond prices rise. Short-term Treasury bonds at 3.75% currently provide real income while you wait for that moment. This is insurance, not growth. Allocation number 4, cash reserve, 10%. That is $2,000. This is not laziness. This is strategy. Market experts recommend keeping 5 to 10% in cash for opportunistic deployment when volatility creates attractive entry points. The Iran situation could escalate tomorrow. Gold could drop to $4,000. Stocks could correct 15%. Having cash available means you can buy the dip instead of watching it helplessly. So, here is the final breakdown of my personal $20,000 allocation for May 2026. Gold and precious metals, 35%, $7,000. The safe haven, the inflation hedge, the central bank favorite. Stocks, 40%, $8,000, focused on AI, defense, and energy, the long-term wealth builder. Bonds, 15%, $3,000, short-term treasuries for income and rate cut positioning. Cash reserve, 10%, $2,000. Dry powder for opportunity, total $20,000. Diversified, balanced, positioned for both upside and protection. That wraps up today's special analysis on Financial News Daily. The world in May 2026 is more complex than at any point in recent memory, shaped by war, inflation, shifting monetary policy, and the AI revolution. But complexity creates opportunity for those who stay informed. One final important reminder: everything shared in this video is for informational purposes only. All market data and analysis are based on publicly available information as of May 29, 2026. This is not financial advice. This is not a recommendation to buy or sell any asset. Every investor's situation is unique. Please consult a qualified financial advisor before making any investment decisions. All information presented here is for reference only, to help you think, not to tell you what to do. If today's analysis gave you a new perspective on your finances, please give us a like and hit that follow button so you never miss our daily market briefing. Your financial future matters. Stay informed, stay ahead. See you tomorrow right here on Financial News Daily.